So I think we slowly can get started to this workshop today. Good afternoon or good morning. My name is Patrik Frei. I'm the CEO and founder of Venture Valuation. And I will be doing this workshop today on company valuation and financing together with my colleague, Gergely. So I think, let's see if we can get here to the next slide. I think just in general, this is part of our Biotechgate digital partnering event. As you probably, or as you well know, this is our 11th event that we're doing, Biotechgate digital partnering. We have again over 1,000 people that have registered for this 5 days of partnering. It's actually 24/7. We have companies from all around the world, over 50 different countries. There are many meetings already scheduled, and I just encourage you, have a look. Have been even over the weekend new people that have signed up. Have a look if you find any partners, investors, people you would like to have discussions. Have a look and send them requests and see if you can arrange a meeting. Also, I'd like to encourage you, if you have never participated in our coffee buddy sessions, I put here the times. We have that Monday, Tuesday, Wednesday, and Fridays at 1 p.m. and 7 p.m. European time, or 7 a.m. and 1 p.m. Eastern Standard Time. Here at the coffee buddy session, we try to bring together people and provide a platform to interact. So it's quite interactive. You can talk to other colleagues and other people that participate. And we typically put 4 or 5 people in one Zoom room, and you can, for 10 minutes, and you can exchange, and everybody tells a bit what they do. So we try to replicate a bit the face-to-face meetings and coffee breaks that you have at face-to-face meetings. Good. So I think we can get started. Just as a background, if you don't know, Venture Valuation, we are actually doing 3 different things. So one is we offer independent valuation of companies and products. We do that all around the world. We have done about 800 valuations so far since we started in 99. So we've been doing that for over 20 years. So valuation is one part. We also run Biotechgate, which is a business development database. Doing valuation, you need a lot of information. So we started also 20 years ago with this platform, collecting information on fundraising, on licensing deals and deal terms, on companies, on assets. And Gergely will talk a little bit about some analysis that we can do out of Biotechgate. Then we also have Hello Partnering, the software which we actually use for this Biotechgate digital partnering. So these are the 3 different areas we do. I'm based, we have the headquarters here in Zurich, but we also have people in different parts of the world, UK and the US and Malaysia, India. So we are quite an international company as well, doing valuations and working with Biotechgate partners and providing our Hello Partnering software. So what do we like to do today? First, Gergely will start with an overview of some biotech and financing trends that we've seen over the last year, and where we think it might go, where it could lead us. So giving a bit of a background, I will then take over and talk about when you raise money, who are the right investors, what you should do and not do, maybe when you raise money, what's important, and then talk a bit about different valuation approaches. So that's kind of the goal for today. We will be recording this session as well, and it can be viewed afterwards on demand in the partnering platform. We will also post the slides and save them also in the partnering platform, so they can also be downloaded. If you have any questions, you can put those in the Q&A form and we will have a look at the end to see that we can answer, depending on time, that we can answer some of the questions you have. Yeah. Good, perfect. Then I'd like to hand over to Gary, who will give us a bit of an overview of the financing trends and what has been happening on the market.
Yeah, thank you for setting the stage, Patrik. So first, I would like to reflect on market downturns and recoveries by looking at the price development of the Nasdaq Biotech Index. So on this chart with red, you can see the market downturn signals, and with green shows the market recoveries. So typically, market downturns lasted anywhere between 1 to 3 years, with the burst of the genomic bubble being the longest and causing the most significant correction. For now, the current market correction seems to be the second longest and the second most severe. By the gradient of the green arrows, we can also see that market recoveries tend to appear faster and faster. And it's good news that it seems that the recovery of the Nasdaq Biotech Index has already started. However, we don't know how this green arrow is going to continue, or in fact, if it's going to continue. So what is causing this uncertainty? On the one side, the good news is that some of the major threats are out of the bag. So this is the retreat of the generalist investors, post-COVID hype, the legislative changes in the US impacting pricing and patents, the rise in inflation, mass layoffs, which, by the way, continue to appear, and a record number of small and medium companies trading at negative enterprise value. And the FDA has also approved fewer drugs last year compared to the previous years. On the other side, it is still unclear if the full effect of these changes has already played out. But so just to also have a positive note, science is taking greater leaps forward than ever, and there is an increasing number of clinical trials as shown by the FDA IND receipts. Furthermore, first-in-class drug approvals are increasing, and 2 multi-billion-dollar markets are opening up, namely the obesity market and the Alzheimer's market. So next, we are going to look more in detail at IPOs and secondary offerings, and also private equity financing. So for the analysis, we used our own data from Biotechgate, as Patrik mentioned. So Biotechgate is a business development database for life science professionals. And from Biotechgate, we only looked at companies which we categorize as biotech therapeutics and related molecular diagnostics. So in the data set, there were more than 8,500 private equity rounds, IPOs, and secondary offerings going back to the 1990s. However, for the analysis, we only consider rounds from 2010. In general, in the data set, most companies are headquartered in the US and are developing small molecules and/or immunotherapies. So first, let's take a look at the IPOs. So our data set is inclusive of IPOs and non-IPO market entries to public markets, such as reverse merger. This is why we call this category as going public. From the charts, it becomes evident that 2020 and 2021 were really, really good years for biotech. Counting from 2010, close to 40% of the IPOs happened in 2020 and 2021. In these 2 years, companies raised more than 50% of the cumulative amount as displayed on the chart. In contrast, last year, the IPO market plummeted, going back to 2016 levels in terms of volume and approximately 2015, 2017 levels in terms of invested amounts. So this is an approximate 80% drop compared to last year, and is now at a lower level than just pre-COVID levels. So one of the implications of a low IPO market is that VCs might find it difficult to exist, and then this can cause other financing issues down the chain. However, typically there is a lag between VC financing and public market financing trends. So next, let's take a look at the price action of companies which did an IPO between 2020 and 2022. And here we displayed the price action after 1 month, 6 months, and 1 year. So we can see that on a median basis, stock prices are declining. And this is despite most companies being in the clinic at the time of the IPO. So the bottom 5 companies lost approximately 80% of their value in 1 year. However, the top 5 companies gain multiples of their initial value. We are also planning on releasing additional research looking into the qualitative differences between the top 5 and the bottom 5 companies. And you can get notified about the release of this research through our newsletter, or you can also follow our LinkedIn page. So next, let's take a look at the secondary offerings. So both in terms of count and invested amount, again, 2020 was the best year for follow-on offerings. Compared to the peak of 2020, there is an approximate 50% drop in terms of count and a 60% drop in terms of invested amount. So depending on the average cash runway of small, medium companies, we might see an increased number of secondary offerings this year. Alternatively, as large cap biotech companies have approximately $200 billion cash at hand, we might see an increased level of M&A transactions as the bargaining position of cash poor companies weakens and pharma pipelines are going through their natural cycle. So next, let's take a look at the private equity rounds. So private equity rounds have been steadily increasing until 2021, both in terms of number of rounds and total amount invested. 2020 and 2021 make approximately 30% of private equity rounds and approximately 40% of the cumulative invested amount since 2010. In terms of invested amount, Chinese biotech companies were able to attract significantly more capital during the peak years of the COVID pandemic, outgrowing Europe-based biotech companies in 2020. On the other hand, there have been many more rounds raised by European companies. And on the next slide, we are going to see how this translates in terms of amount raised per round. So although US-based companies are leading in terms of total amount invested and number of investment rounds, China-headquartered companies have been able to attract the most capital per round. So the chart also shows the struggle of European biotech companies, namely the relatively low investment amount per round. So regarding the series, in 2022, on average, a seed round was about $7.8 million. Series A round was at $43 million. So this is excluding the gigantic round of $3 billion from Altos Labs. And the Series B round at $66 million. And later rounds move between $70 and $113 million. So compared to last year, we could see a double-digit decline in most of the rounds, except Series A, which slightly increased, and Series D, which increased very significantly. So with this, I would like to conclude the market trends review and give back the word to Patrik.
Mute. All right, perfect. Thanks very much for this, Gary. That was a very interesting, view of just last couple of years how the financing have developed, and I think taking from all of that, what we can see, that really the 2020 and 21 were really significant years, right? That I mean, we had huge growth in terms of financing of in IPOs, in post-IPO, and also in private equity. And now we have seen markets go down. But if you look at it and compare to pre-2020, actually, the reduction is not so significant as compared to 21 and 2020. So I think even though it's going down, there's less money available, or was less money available last year. If you compare it to previous years, I think that's still there's still some hope. And we don't know what's going to happen in 2023. As Gary said, in the market, a lot of events have been already priced in, but it's at the end a crystal ball, and we don't know where things are going to go. Now, what we can do, we can look at what are valuations, and that is what I'd like to cover in the next part. However, first of all, maybe talking about valuation, always or most of the time, it's about talking to investors. So what I'd like to kind of cover is who are the right investors, and maybe give you some ideas, some feedback if you raise money, and what's important. Now, we talked about that. I mean, fundraising challenges have been ever since there's biotech. There's a challenge to raise money. So the cost of development are becoming more and more expensive in general. So we typically see companies need to raise bigger rounds, more money, and as Gary showed, the value that often companies raise in the different series has gone up, and that's reflecting that a bit. In the US and China, as he mentioned, the rounds are quite significant, and companies are able to raise really substantial money. In Europe, this is a bit more of a problem where companies can only raise smaller rounds. And obviously, at the end of the day, all these companies, they need, if you want to bring a product through the market, on average, you need the same amount of money. So that's obviously a problem. At the end, you need to find that money somewhere. Now, also pricing is under pressure, as we have seen in the US, especially. Might have only started in a very target market, but we don't know where that's going to go, and that's obviously also makes it more difficult at the end of the day for investors if the products getting to the market are under price pressure. Now, with all the markets going down, and with the IPOs and it looks like a lot of investors in public companies have lost money over the last couple of years. So there's a certain disappointment of investors, and so investors might be a bit more careful. And also with all the uncertainty in terms of inflation, in terms of the war, there is also, if there's risk adversity in the market, obviously, biotech investment, that's the top of the risk scale. So that will also have a certain impact. So overall, raising money is a challenge, and it's probably more difficult now than it used to be 2 years ago. There's more projects there as there is funding available. On the other side, we still see a good amount of money that is being invested, and we see good companies will be able to raise money. As I mentioned before, we do valuations for a lot of companies who are raising money, and we see that they're still able to go to investors and are able to raise money that they need. But it has not become easier. So how do companies cope with fundraising challenges? What we've seen over the last couple of years, and I think also pharma companies will become more important also in financing biotechs in the coming years. On one side, the pharmas, they have the constant problem of having their blockbuster dropping off the patent cliff, so they have to have new projects. They do less in-house research and rely more on outside R&D. So there will be more M&A, there will be more licensing, we think. So we see that we have more investors coming also from investment coming from the pharma side. Also family offices, this has been a trend in the last couple of years. They're difficult to identify, difficult to find, but they have become a driving force, specifically also in Europe. And also we see that in Asia, where there's significant investments coming from that side. One of the things we see as well is VC financing, that they only finance a specific product or project, and maybe not the whole company. They're looking at the specific technology and even create a company around that specific product. So that's one of the things. And then obviously public money, very important as well. A lot of times when we talk to companies about valuation, we see, how much money they've been able to raise also from non-dilutive financing, from grants, and that's available in Europe, but also in the US, and that is a significant portion. Fee for service, sometimes companies coming actually out of that area, that they provide fee for service and then move into actually their own development. These are especially companies now that are, we see companies that, have been making a lot of money from services and now have that financing available for their own development. And at the end of the day, I think what you have to do, well, you have to understand what are investors looking for, and then try to offer what they're looking for and talk to the right investors. Do your own due diligence. Go talk to the investors that actually are a good fit to what you have to offer. Right? It has to be a good match, and I will talk a little bit about that now as well. So equity financing, there's different ways or different sources where you can get equity financing, beside public financing, beside other financing, but equity financing obviously is a big portion. And when we talk about valuation, typically this is in relation to equity financing. Now, if we start with venture capital investors, often we see companies raising, a couple of million, 1, 2, 3 million, and going across the Atlantic, trying to raise that amount from VCs, far away, is not realistic. I would say venture capitalists tend to invest higher amounts of money, and you can just imagine if a venture capitalist has $100 million fund, right? They can invest 10 times 10 million. Right? So in 10 different companies, or they can invest 100 times 1 million. Now the work, if they do an investment, is probably quite similar if they invest 1 million or 10 million, right? They have to do the due diligence, all the legal aspects. They have to probably talk to 50 companies to choose one. So investors tend to have a certain amount that fits their fund. And if they have a big fund, they will not typically invest small tickets. So venture capitalists, typically we see that they would invest north of 5 million. So this is kind of something you can think about. Typically also they invest high risk, high potential companies. And again, overall companies that require probably multiple rounds of financing, so have a high capital requirement. Plus also here, venture capital funds typically have a set time life, that the fund has a life until when all the money has to be invested and when it has to be paid back to the investors of the fund. So investors, venture capital investors, typically very much focus on potential exits as well. So that they're looking for a clear exit strategy of the company. So that's important if you go and talk to VCs, you know, that you have an exit strategy. If you talk about corporate investors, here in terms of the size, I would say they're more open. Often it can be a strategic fit. They're looking for innovation. It depends a bit on the fund, obviously, but there's funds which are looking to invest in companies that fit their own pipeline, and some actually to complement the pipeline. Right? But again, you have to do your due diligence. But here, I think in terms of the size of the investment, they're more open. It's closer to VC in terms of how much money the companies will need, and pharma companies, they have money and, you know, can invest. The benefit also with corporate investors is there's potential M&A, that the pharma company would acquire the biotech at some stage. So that's obviously an interesting aspect as well. If you talk about family offices, here, I think depending on the family office, the size is also open. It's not too restrictive. We have seen also here maybe a bit less family offices be a bit more risk averse. So they also like if there's a service component. They're more opportunistic in terms of where they invest. Maybe the capital requirements is a bit lower than for with VCs, depending again on the family office. And here, exit, it can also be a long-term partner. So maybe they're less driven to have an exit and can be a longer-term partner depending on the company. And then, if you look at business angels here, typically the amounts are smaller. So if you raise a smaller amount, the seed round, you know, that's maybe for business angels and smaller amounts. But also maybe the total capital requirements is a bit lower. And exit, I think, is still important, but less driven as it is with a venture capitalist, which can be a good thing. Also, if you work with a venture capitalist, they need to have an exit. You know, that might be, you know, something that the company wants as well. So you know, that can be aligned. But just here, a bit of an overview. So I think it's important, depending on what kind of money you need, what the strategies of the company, you would go to different kinds of investors. Now, if you do go to a venture capital investor, or, you know, actually any investor, what shouldn't you do? Something we often see, and we think, you know, that may be something that can be improved. And one of the things is to be in the first discussion, you know, be extremely technical. It comes from nature that an entrepreneur who's coming from a, you know, technical background, you know, that's where you feel most comfortable. But I think for a potential investor, the science is important, but, you know, it's also the business side, you know, the finance, how much money will you need? How will you spend? What are you planning to achieve? So not just looking back what you have done, but also, you know, what are you going to do in the future? So it has to be balanced. And often we see, more often than not, that, you know, the technical part is just overwhelming. So I think here to be a bit restrictive. Then if you make statements, you know, we are the best, we are the only one, you know, there's no risk involved, you know, we're gonna, you know, be take over 100% market share, things like that. It's very general, or it just doesn't make sense. So I think if you make statements, make them realistically, and try to underlie or get benchmarking information where you can say, okay, your similar product, that's what they achieved, this is what we're trying to do as well. Don't underplay or ignore competition. There probably will be other people in the market. There might be similar technologies out there. It's not a bad thing to have competitors. If you're the only one, the question is also, why are you the only one? So, you know, to show where you are different, where you have advantages, but don't underplay competition. Same with risks. There are risks. Every company has risks. It's better to put them on the table and discuss what you already have done to mitigate these risks than to say that there are no risks involved, which we've heard before. And obviously that's not something investors believe. They've been around the block as well, and they understand that every company has risks. The funding process, don't take it lightly. Don't expect that you start fundraising today and tomorrow you can close. It takes typically much longer than you think. If it takes 12 months, that's already quite good. Sometimes it takes longer, and you need money to do fundraising. Obviously, that's always a problem. So you have to start early enough with that, and it will take time, right? And obviously, if you raise money when you desperately need it, that's not a good place to be. The best time to raise money is if you have money, right? If you can go to investor and tell them, look, I'd like to talk to you, tell you what we do, without having to raise money immediately, right? Then you're most interesting. If you can tell them we don't need money at the moment, that's when they want to talk to you. If you raise money between milestones without being able to really have achieved, kind of a next milestone, that's difficult. Try to avoid that. And so get enough funding, ask for enough money, right? There's not a problem to ask for money and ask for enough money to be able to get to the next milestones. And even if then it takes a little bit longer and costs a little bit more, that you can still get there, right? So otherwise you will be just, you have to raise money before you actually get to the next milestone, and that's always very difficult. So if you talk to investors, you should have a business plan. And I know, business plan are never followed. It always happens, it's different. It costs double the money and takes twice the time. But on the other side, having a business plan, having things on paper, it shows that you're structured, that you have a plan, you know what to do, what you want to do, where you want to go. Sometimes when we do valuation, we have a discussion with a company that doesn't have a business plan. Things might change from one day to the next, and that's, for an investor, it's very difficult, right? I mean, if today you do this, you talk to somebody, and then suddenly you want to go another direction, another indication, you want to have a different strategy when you want to out-license. All of these things, it's good to have a plan. Again, the plans are here that will change, but it's good to have such a plan and be able to provide that to potential investors. Substantiate statements with market data, how much, how big is the market, but also be realistic. You will not cover the whole cancer market. At the end of the day, if you have a cancer product, you will have a specific indication, and even within this indication, there's a specific patient population, and maybe it's a second-line treatment, maybe it's a combination. So, you have to be realistic, but provide kind of underlying market data, and maybe even what kind of revenues do other companies achieve? How many patients for a clinical trial did another company use? These are good benchmarks that you can use. Summarize and structure the financial information properly so an investor can see how much money you need and how you're going to spend that money, where you're going to go with this investment, what will you be able to achieve, and then maybe how much money you will need in the next round, right? It's good to have this kind of bigger picture, what will be needed. And again, things might play out differently. You might out-license earlier than you expected, and an investor will be more than happy with that. But it's good to have this overview. Then at the end, network. You have to talk to many investors to get the right one. It only takes one, but you probably have to knock on 100 doors, to get the one or two investors that you need. So you have to go out, use conferences like Biotechgate Digital Partnering, but also use face-to-face conferences where you can meet with investors. So you have to go out there actually before you need the money. Start these relationships before, because investors, you know, they would like to have see the company over time and maybe stay in contact, and then when you raise money, you can go back to them and they've heard of your company before. And then you can also do reference checks on investors. You can see where they have invested and what portfolio companies do they have, and you can call these companies and ask them, right? There's no harm on also doing a check on investors. If you talk to investors seriously, also see how much have they invested, right? There's also investors, people out there who say they invest, but you know, maybe they haven't invested for the last 5 years. They're maybe raising money themselves. So it's good to have this information. Ask the investors if they have the money that they can invest. So do the reference checks. Now, in terms of valuation, obviously that's always a big part. It's not the only thing, but if you raise money, valuation is obviously very important. And this is obviously that's what we do. That's our daily work. We doing valuation. So one of the things when we talk about valuation is that there's price and there's value. There's two different things. And often when we talk to companies, you know, we get the feedback, maybe, why should I do a valuation, right? I go to the investor and the investor tells me what we're worth. Well, that's maybe not the best starting point to have a discussion. I think it's good for the company to have an idea what could be a realistic value of the company and of the technology. The price at the end, that's supply and demand. And, you know, if you have 10 investors who want to invest, you probably can get a good price. If you only have one investor, you know, at the end of the day, you need the money. So at the end, that's a negotiation. But it's good to understand what is the value. It's like when you buy a house, right? You may get an independent valuation of the house, so you know what could be kind of the value. But at the end, you have to negotiate the price that works for the seller and the buyer. So Warren Buffett put that very nicely. Price is what you pay, value is what you get. So when we do evaluation, we try to estimate the value range, and which is then a basis for negotiations or an investment decisions if we do the valuation for investors, to see what could be a fair share price. But at the end, we are not setting a price. The price is then really negotiated. So what we provide is more a tool for companies that, who raise money to get an idea. And I think especially now when we had a high, you know, the market that was, the public market was very high. We had lots high valuation also in the private side. And now the market coming down, as Gary said earlier, this also has an impact on the private rounds. And I think we see a lot of uncertainty in the market now. Companies raising money, you know, they may have a high value in the past. The question is, do you have to do a down round now to get to raise money in the next round? Can you maintain the round? You know, can you even go up? And so we have a lot of these projects where we try to see what is a fair value today. You know, how does that work then also with the market development? So that's obviously one of the key aspects. And you know, the question that we are trying to answer is, how much equity do I have to give away for a specific investment? So in this case here, if we have an investment of €500,000, you know, the question is, how much does the investor get? If you have a pre-money value of 1.5 million, that would be a post-money value of 2 million. The investor would get 25%. So when we do evaluation, we try to come up what is a pre-money value of the company, or a range, a pre-money value range. Investors sometimes they do exactly that and say, oh, I'm going to invest $500,000, but I want to have 25%, or I want to have 50% of the company. So they will imply a value through the requirements in terms of shares they want. But we try to really come from the other side and see what is a pre-money value, what is a fair value basis, and then go from there. So this is one of the reasons why we do valuation. The other reason is actually when we do product or asset valuation. This is then more for licensing deals and deal terms, where we try to see if you have a product that you want to out-license, or we work for a client who wants to in-license a product, we can then see what kind of values does the product have and what kind of deal terms would you have to pay, how much upfront, how many milestones, kind of milestones and royalties would be a fair basis. And again, that's a basis for discussion as well. So life science valuation, biotech, but also in medical devices, we do about half of our valuation, we do our therapeutic biotechs, and the other half is diagnostics, some medical devices as well, health tech. One of the problems is that you cannot really use traditional methods. So typically the companies we value don't have any revenues. Right? They don't have any profit. So PE ratio, profit price earning ratios, or revenue multiples don't really work. Because most of these companies, for quite some time in the future, they will not make any revenues. They might be sold before they have ever any revenues. So we can't really use these traditional methods or asset valuation, or the assets are intangible. It's know-how, it's patents. So we have to use different forms of valuation. However, valuation is very important for these companies. As I mentioned, as you know, a lot of companies have to raise multiple rounds of financing. So it's important that you don't start too high, because that might be difficult then to raise follow-on rounds. But if you don't want to start too low, because otherwise you give away half of your company, and with future rounds as investors or as founders, you end up with literally nothing. So it's important to start kind of the right level. So that's important. And then also, if you do licensing deals, valuation is always a key aspect as well here. So valuation, it's difficult, but it's important. We are also talking about complex technology, new technologies, often unproven technology, but if they work, very, very high potential, interesting. We have patent situations that protect these technologies. So it makes it relatively difficult to do valuation. We have also these high uncertainties. If something works or doesn't work, that it's a high risk, but then also high potential for the investor if it works, and it takes a long time. So these are all aspects that make these valuations rather challenging. We have people that say valuation is more an art than a science, or even a black art. But it's definitely not trivial, but it is important. So doing valuation, one of the things I think is also important is put yourself in the mindset of investors. And I just mentioned before, risk return is a big aspect. For investors, obviously they would like to have no risk and high return, right? That would be ideal. But in general, investors in biotech companies, they understand they have to take a high risk. The risk is there that the money is lost, the project doesn't work, but then they expect a high return, right? And typically investors will invest in several projects, in several companies. So it's a portfolio approach. And they expect that some of these investments will actually play out very well, and some of them will not work. But the ones that work will have to compensate for the ones that didn't work, right? Investors typically have also pressure from their own investors. If you have a venture capitalist, they have to go and raise money as well. They have to deliver a return to their investors as well. And so for them, they also have to look at exits, and they at the end compete in the capital market, right? The money goes where there's an interesting risk return. And, you know, that comes back also in terms of valuation. Risk return is important. It's not just the return that you generate, is also in relation to the risk. And I put here some examples. If you have a government bond, nowadays, you know, you have the risk of failure if you invest in a US bond or a German government bond 10-year. You know, there is the risk of that you don't get your money back is very low, but your return is also extremely low. You know, it used to be negative, for example, in Switzerland. We are now also again in the positive side, but it's very low. And the more risk you take in making investments, the more return you expect. You know, if you invest in bonds or if you invest in blue chip companies on the stock market, your probability that money will be lost is increasing with shares. So you expect a higher return. But if you invest in biotech, here you have a higher, this is just an example, 80%, but you obviously have a much higher risk than investing in a blue chip company. But if the company makes it, you know, you get also higher return, and that's what investors also ask for. So risk return is quite important also in the context of valuation. So when you talk to investors, you know, you should always try to provide them also what is this upside, you know. One of the things, you know, when we talk to companies about the strategy, which indication they should go, because that's often also a discussion we have when we do valuation. You know, for investors on one side, they would like to have this upside risk, this, you know, this high potential. On the other side, they're looking for a short-term goal or shorter-term route to market. So often a combination between an orphan drug and maybe a bigger indication, which takes longer to achieve, you know, can be quite attractive. But these are things we often discuss when we do a valuation. Now, risk obviously is a very important aspect when we do valuation, and this is just talking a bit when we do a valuation of a company. We're trying to assess the company, trying to understand what are the key risk factors. And that actually translates into valuation. So the valuation at the end is the potential and the risk. And trying to understand the risk, we do an assessment of the company and quantify these risk factors. And typically, these risk factors or this assessment is kind of we can summarize that in three main aspects. So we look at the management. So we try to understand who are the key people of the company, what is the track record of them, have they, you know, maybe successfully run the company before, have they worked together? So that's one aspect. We look at the market, at the potential of the product, the market opportunity. We look at the competitive landscape. How is maybe this company or this technology different in the market? And then the third aspect, the science and technology. So we look at the IP. We look what is unique about this technology. We look at maybe collaboration that the company already has. So there's different aspects that we include in the valuation and in our assessment. And at the end of the day, we need to understand all these different fundamentals to do a financial valuation, because at the end, we have to make assumptions. And I think this is one of the key things when you do a valuation. There's lots of assumptions you have to take. And it's like looking into a crystal ball, and we don't know what tomorrow is going to bring. But these assumptions on the other side are really key. So, you know, understanding kind of the fundamental of the company is really important to making these assumptions. So the assessment and assumptions are actually much more important than doing the calculation. At the end, the calculations, that's the easy part, but doing the assumptions, taking the assumptions, having reasons why you take these assumptions, this is actually the key, or that's the most important thing. So typically when we do evaluation, we have from our side, we work with the company, we do like a workshop or one or several conference call where we have different people from the company, in the call, from the scientific, business development, finance, and we try to define these risks and translate these risks then into the valuation, into numbers. Through, it's typically through the discount rate or success rate. I won't be able to go into more details here, but this is typically how we really translate these soft factors into numbers. And at the end of the day, the higher the risk, the lower the value, and the lower the risk, the higher the value. Now, as a company, if you have that in the back of your head, so what can you do to increase the value of your company? Well, you can try to reduce risk, right? And bringing a product from preclinical into the clinic through the different clinical trials, basically this is reducing the risk, right? You have a proof of concept. You actually show that it works, and this actually reduces the risk and increases the value. So the value typically increases over time as the product goes through clinical trials. Now, there's a whole workshop on these valuation, how we do that, but unfortunately we don't have time to go into too much detail here. But in general, we use different types of approaches for the valuation. So kind of looking into the future crystal ball, that's one main approach, and kind of operational based. It's based on business plan fundamentals. But we also look at market-based methods. So we are trying to see what is paid on the market, what similar companies have been financed at what valuations, or public market, what is being paid for publicly listed companies. So there's different discounted cash flow method. There's the RNPV, risk-adjusted net present value calculation. Also real options. On the other side, we have the market comparable and comparable transactions. But also venture capital method, and I'll come back to that. But at the end of the day, there is no right method. There is different approaches. What we do when we do evaluation, we typically use 3 to 4 different approaches and get an average and get a value range. But it's not that everybody uses the same approach and gets to the same value. Unfortunately, or probably fortunate for us, there's different ways of looking at it, and we try to always provide kind of a balanced view when we do valuation. Discounted cash flow, basically here you try to look into the future, what kind of profit can a company generate, and see what is the present value of that. As I mentioned, there's a whole workshop around that we do. If we do evaluation of an asset, of a therapeutic asset, it's basically the same approach, but we typically have a bit longer time horizon. So we try to look maybe 20 years into the future and see what kind of revenues can this product generate when it gets to the market, if it gets to the market. When is patent expiry, and would we expect losses of market share, because generic competition or biosimilars will get to the market. We also would look at how much will it take to bring the product to the market, how much investment will be needed. And we also would see what is the probability actually to get the product to the market and through the clinical trial. So this is the risk-adjusted net present value calculation. This is something that we use, as I mentioned, when we talk about therapeutic products and companies. The comparable valuation here, we're trying to see and look for similar companies that have been either financed or publicly listed. The problem here is that, first of all, we can't use the traditional ratios like PE, price earnings, or enterprise value, EBITDA or EBIT or sales. these companies typically don't have any earnings or positive EBITDA or sales. So these ratios don't work. So we have to try to use different ratios. For example, investment in R&D, number of employees, and how much money a company has raised, or products in development. These are not perfect ratios. And here in the example, if you have a company that's valued at $50 million, has 50 employees, we have a company that we have to value, they have 10 employees. Just based on this ratio, we would have a value of 10 million. Now, if one company is fully integrated, they do everything in-house, and on the other side, we have a company that is maybe at the same stage, should have a similar value, but is a more virtual company. They outsource everything and thus have much lower number of employees. You just get a lower value because you have fewer employees. So you have to be very careful with these comparable company valuations. Nevertheless, it gives also an interesting perspective. And this is why also we use different methods to do valuation. Because you have these shortcomings in the comparable valuation. In the RNPV calculation, you have to make a lot of assumptions, which again, you don't know if that's going to materialize or not. We also have something called the venture capital method. Here, what we do, and I think this is also an interesting exercise for a CEO. In the venture capitalists, as I mentioned, they are driven to exit rather sooner than later. So an investor, typically before they invest, they already think about potential exits. So an investor would try to estimate at what valuation can they exit a certain company. So for example, if you have a preclinical company that an investor is looking at, he will think, okay, maybe when this company has a phase 2 a finished product in 3 years' time or 4 years' time, we could sell this company for 200 million, because on the market we've seen pharma companies are buying such companies for 200 or 400 million. So they would do an exit valuation. What could be the value at an exit time? And then calculate back and see, okay, if we can sell the company for 200 million in 4 years, what can we pay today? They're not going to pay 200 million today, because obviously the investor wouldn't make a return. So depending on the risk they take, they expect a certain return over this 4-year period, and you can calculate the possible value today. Or what you can also do as a CEO, if you have a value in mind that you think your company should be worth, you can calculate what would be an exit value that an investor will still make a return. And that will give you a bit of a perspective, what is a realistic value. So I think this is a good exercise, and this is also something we include in the valuation when we do the different approaches. Good. So just to come to a conclusion, I know it's a lot of information, and as I mentioned, there's a lot of things we can go into more detail. But the goal was really to give you a bit of an overview when you talk to investors, what's important, and also just a few kind of pointers in terms of what's important, looking at valuation. Now, raising money, you have to think outside the box, be creative. At the end, you have to talk to many different investors, provide them with information, talk to them ideally before you need to raise money, keep them in the loop, meet them, and then when you need the money, that you know to whom you can go, you understand what they're looking for, you already understand, is that the right investor for you? But yeah, go outside, think outside the box, and try to also approach, not just send an email, but talk to them, meet them at conferences, try to give them information that is interesting to them. It's a numbers game, so you have to knock on many doors to find the 1 or 2 investors that you're looking for. Try to use alternative ways of funding, grants, non-dilutive funding. But I think what's important is that you don't lose the focus. Sometimes you see companies that then suddenly go off and do something totally different just because there's some grant there that they could get. At the end of the day, you have a product, you have a technology, you have a strategy that you want to follow. You have to be opportunistic to a certain degree, but at the end, I think you keep focus on what you think is the right way forward. Now, valuation is all about assumptions, as I mentioned. I tell people always, I can make any valuation you want. It comes back to the assumptions you take. When we do evaluation, if you do evaluation yourself, try to be objective. I always tell people we are Swiss, we are neutral and independent, and we try to do that when we do valuation. Sometimes you have to be a bit more optimistic in certain assumptions, but then at the end, it's always balanced. If you do everything very optimistic or everything very pessimistic, obviously you get a huge range of value. And when we do valuation and work with a client, we really try to be objective, provide really what is the basis, what is a fair value of the company. There's price and there's value. There's two different things. Evaluation provides a basis for price negotiation. If you do evaluation, that doesn't mean the investor is going to pay exactly that. But it helps, to see what could be a fair basis of value. And as I mentioned before, if you want to increase the value, try to think about how you can reduce risk. Risk just for the company, but also in the view of a potential investor. If he thinks that you're not telling the full truth, obviously, that increases his risk and makes it less likely for him to invest. So that's maybe an interesting way also at looking at things. What can you do to reduce the risk of the company? And nowadays, I think where there's a lot of external risk as well, I think even more important. Good. So I hope that gave a little bit of an overview in terms of valuation, what's important when you speak with investors. We already have a few questions that I will try to answer. If you have other questions, please feel free to drop them in the Q&A box. We have here first questions. Please make your attendees aware of alternative investment, especially if you are developing strategic partnerships. Yes, with CROs, CMOs, and pharma. Yeah, so I think that's corporate investors, but also working with service providers. I mean, a big portion of the cost is CROs. If you find partners that will provide that in a collaboration, in an investment, I think that's definitely also a way of raising money or financing the company. So that's definitely, and I've seen CROs who offer that, but there are also others who say we just focus on providing the services and we are not an investor, right? So, but that's always a possibility. Then in your description of the venture capital method, you did not explicitly take out into account dilution. Exactly. Yes, so I didn't talk about that. That's a good point. Obviously, if you do a venture capital method, so you look at the exit price, you have to include all the money that is needed to get there. So there will be maybe further rounds, and this has to be taken into account. So obviously, if you have 2 or 3 more financing rounds, that it makes it a bit more complex. You can try to model that, but then you need to know how much money company would raise and at what valuation. So that makes it a bit more complex, but I think overall the concept is important, looking at an exit price and calculating back. But obviously that's it's also important to take the dilution over time into account. Then do you do this with the standard discount rate or calculating dilution? Do you plan rounds until exit? Yes, so we plan until exit and at different financing rounds, and so you have to use different valuations. Hopefully that answers that question. Then can you elaborate a bit on the product investment model? How do you deal with companies addressing multiple indications with a single drug substance platform? Yes, so I think that's more often a question, right? If a company has one product and it can be used for different indications, how do you value that? A company would like to have, maybe 10, 15 indications included in the valuation. And unfortunately, it doesn't work like that. What we try to do when we do valuation of such a platform company or product, realistically, what would a company be able to finance? How many trials? They might be able to do 2 different indications at the same time. Maybe not both right at the same time. Maybe they're a bit shifted in terms of the time, because an investor would first like to see in the first indication, does it work? And if it progresses, he might be willing to get the second indication going. But it comes back to what kind of resources are available at the end of the day. And that's how we try to put things in perspective. And just out-licensing it to a third party, to a pharma companies, even the pharma companies will not do everything at the same time. So at the end, that's kind of the test for us to see how many assets we include, is what resources are available to actually develop them. So I hope that answers that question. How do you valuation service charge? So typically it's on a flat fee basis. So when we know the company, when we know the, is it a company valuation or is it an asset? We can give a fixed fee. So we don't charge on an hourly basis, but it's really a fixed fee because we understand also companies raising money. It's good to understand, how much something like that costs. A product and asset valuation is around 25,000 to 30,000 euros or US dollars. And a full company valuation is between 30 to 40, 45,000 US dollars or euros, depending really on how many assets they are and how many indications. So that's kind of a parameter. Do you work for equity? No, unfortunately, we don't. We wouldn't be independent anymore if we get a share of the company, right? If we say the company is worth X, and by the way, we also have equity. So it's really purely on a fee for service basis. So we cannot take equity or work on a success fee basis. We had also that question in the past. At the end, we cannot influence the success if the company can raise money or not. We do the valuation, we provide a basis, but at the end of the day, we work on a fee for service basis. But we do that all over the world. As I mentioned earlier, we have done over 800 valuations in Asia, in Australia, New Zealand, in the US, in Canada, and all over Europe. So basically everywhere there's biotech, we have probably done valuation. Good. Then I think we had most of the questions. There was another question, sorry, here. How do you filter out criminal investors approaching startup looking for seed financing? Yeah, that's a good question. To be honest, we haven't had any interactions, or we haven't had that problem. I haven't seen that. I think at the end you do a due diligence, and I think one of the things, if you go back and check where have the companies invested or where has the investor invested, and talk to these companies, that will already give you quite a good sense of who the investor is and if it's serious. Often you can also see that the fund has they have obviously a website, they have press release, how much money they have raised. So you would do your own due diligence, I think. But it's always good to talk to people before you discuss too far down the road with a potential investor. And it's probably also gut feeling to a certain degree if you believe the investor. And I think the old saying if it sounds too good to be true, it might not be true. So I think that's always something to keep in mind. How long does it take to do evaluation? Product valuation, asset valuation, we say about 3 to 4 weeks, and the company valuation maybe 4 to 5 weeks. We also understand things have to be quick. Often companies call us and they need the valuation yesterday, but you know, it does take a certain amount of time to do evaluation. So yeah, I would 3 to 4 weeks. You know, that's probably a good estimate. Good. Then I think that's it from our side. You have here on the slide also our email address if you have any questions in the future. As I said, we provide these slides and recording of this also in the Biotechgate Digital Partnering. Can be downloaded there. Yeah, I encourage you to use the partnering, go network, go see who else is there, get in contact with them. I understand that investors are not always very responsive. They get a lot of requests. You also have to see there's more companies raising money than investors. So the investors are very picky, but they do take meetings. So be very specific what you're looking for and why they should talk to you. I think if you have good projects, there's a good chance that you will get some meetings as well. Okay, thanks very much. And yeah, have a great rest of the conference. Hopefully we can also see you again at the next Biotechgate Digital Partnering in May that we're going to do again. Thanks very much and have a great day.